Good morning, ladies and gentlemen. Welcome to this webinar of the future of the logistics real estate markets in Europe. We are very pleased to welcome you to this interesting topic today. The webinar is organized between BCI Consultants International, and I will introduce BCI in a minute, but also in close cooperation with St. Ange, Tom Bonkenberg, Director of European Operations of St. Ange. We'll introduce later on also St. Ange because he has an important role to play in this session as well. We are very pleased that we have today more than 300 attendees out of 13 European countries to look into what this hot logistics real estate market is going to do. And as we have so many participants, you can imagine that we have put you on mute, but you can always use the Q&A button to pose questions. We see them here on the big screen, so we can then immediately try to respond to that question. We will not mention your name or the name of your company, but use the Q&A button if you have any questions or remarks. Later on, at the end of the session, I will also tell you how you can get this presentation, how you can download it. So no worries that with all the information you have there that you can digest it also in a more slower speed than probably what we will do in this webinar. Let's look into what is the agenda. I will start with a quick introduction of BCI Consultants International and give you the results of the development of logistics real estate in Europe. We did a survey among Europe's leading logistics real estate developers, investors, and experts, and the results will be shown. And we will take we will pay specific attention to the large distribution center, the mega distribution centers, the XXL warehouses, but also the urban distribution centers. Then we move to a timely topic, because wherever we do our work in Europe and also in the US, a lot of companies, whether they are logistics service providers or companies who run their own warehouses, labor market challenges, labor shortage is really a hot topic. So Johan Beukenbaat, partner within our firm, will give you the highlights of what we see on challenges, but also how you can find out whether current locations or locations you have on your radar screen really have the right labor market potential which you envisage if your company grows. And then Tom will talk about the changing business case of automation and robotization. So what we see happening is that, let's say, with the labor shortages which we see all over Europe, the business case for automation and robotization is changing. And Tom will give you a concrete business case to show you how the perspective is changed there. And then I will quickly wrap up with some conclusions. Okay. BCI Consultants International is a company started in 1985, working for a lot of corporate clients on location advice, supply chain optimization, manufacturing footprint strategy, meaning that we look into companies' locational strategies, but also help them with the concrete location they want to find. And part of that is also looking into real estate strategy and projects, as we work for a lot of real estate developers and investors as well. We are pleased to say that we are already now with 75 professionals working in various offices, not only in Europe, as you can see, but also in the US, where we have teams in Atlanta, in Georgia, and 2 offices in California, in San Mateo, which is in the heart of Silicon Valley, and in LA, but also in Shanghai and Singapore. We are very pleased that last year, Forbes magazine, and you can see that on the bottom left, listed BCI for the 3rd time in a row as one of America's best management consulting firms, and particularly on supply chain and location advice. Those were the main reasons for being listed on that list of 200 companies. There are only a dozen or so from Europe. So that's a good recognition, and it shows also that the kind of services, and I will not go over all this, but here you can see on footprint site selection, supply chain consulting, corporate real estate advice, international business strategy, that we work for companies who want to make strategies, but also implement them in life. And here you see some of the clients we work for. You see companies in various types of industries, on life sciences, high-tech, industrial products. And we work for these companies not only in Europe, but could also be in Asia, could be in North America or in Mexico. And here are some other industries as well. So in a variety of industries, we help clients with finding the best solution, what is the best manufacturing strategy and the best supply chain distribution network strategy, and then also find the right locations to do that. A particular group we also work for is logistics services providers, with looking into strategy development, what is the right organizational structure to find out to service clients, supporting them in their commercial efforts, and also looking how we can support them in improving operational performance. And you see on the right-hand side a couple of logistics services providers we work for. But we also work for a lot of logistics real estate developers and investors, because due to our work for these end users, for all these companies I showed you the logo for, it means also that we have to find out what is the best location, and then we cooperate with real estate developers and investors. And that knowledge of location choosing companies is also what we use in terms of strategy development, concept development, or just market analyses and feasibility studies. Hey, we want to set up here something. What is the market doing? And also, and we will come back to that later on, more what is the labor market doing? And here you see a number of well-known names of companies operating in Europe, which we support with the kind of strategic and operational and market support, market services I mentioned before. Okay, let's go to the study. And you see here a sample of the participants who participated in that survey. So we do always, in that very busy period of end November and December, ask companies to come forward with their assessment, their expectations of what the market is going to do. And we focus on 11 countries. So it's UK, France, Germany, it's Belgium and then the Netherlands, in Southern Europe, Spain and Italy, and then 4 Central and Eastern European countries, Poland, the Czech Republic, Romania, and Hungary. So sometimes you will see later on slides where a lot of these figures are combined, but again, we will you can come in the possession of the slides and that will help you. Now, let's look into what we're going to present to you for the various European countries. We will take the take-up logistics real estate in 2020 as a benchmark. Then the expectations of these market experts for 2021, because we did a survey 2021 and a complete European overview of all the take-ups and harmonized with all the different types of definition is not available yet. So these are the expectations. The second bar is the expectations for the take-up in 2021. And then the third one is what you will see the expectation for the take-up in 2022. So what is the expectation of the real estate developers and investors? What will happen this year? We use color coding to see whether there is a growth or a decline. But before going into the detailed results, a little bit about disclaimer. It's not for hiding the results, but it's also for putting them in the right perspective. These are expectations of the market, so there are no guarantees that it will happen. And we will work with data on yields, with data on rents. And we all know that in a certain area, you can have still a variety there, even if you call them prime. So there will be a bandwidth of data in the reality, while we try to focus here a little bit on midpoints, but know that a bandwidth is the reality. And I also would say be careful with high growth figures in small markets. We have large markets, logistics real estate markets, think about the UK, France, Germany, Poland, and they are so huge that they are more stable in expectations. While if you have a smaller real estate market, for example, Hungary, and if you have a high growth figure, you have to put that into perspective that the base is not that huge. Okay, let's look into the combined figures of these 11 countries. If we look to 2021 compared with 2020, then our survey participants expect that there will be a growth last year of 10%. And for this year, they expect a smaller growth, 3%. And the reason for that is that we see that, and also in our own portfolio of activities, that in 2021, there was also a kind of acceleration after the lockdowns, literally, but also in the market of what happened in 2020, the first COVID-19 year. So that was a slower period in the logistics real estate markets. Everybody was certainly in Q2 and Q3 in 2020. Everybody was cautious to develop and set up new warehouses. But in 2021, when we got more used to that, and when we saw that e-commerce was still growing very fast, and that companies wanted to avoid disruption of their supply chains by looking into by building up more inventory in Europe, that's what you see in that element in 2021 expectation, and with a smaller growth, let's say, expected for this year. And you will see later on that it varies per country. Let's look into the various countries here. What we see in the, and starting with the main European markets, here is the growth all over Europe. I mentioned that before, 10% and 3% for this year. You see Germany with light green, meaning a substantial growth, not only this year, but also next year. It's interesting that the three largest markets, Germany, France, the UK, all still expect a growth of 7-8% this year. So higher than the European average of these 11 countries combined. If we look to the Netherlands and Belgium, we saw a very high growth. It's an interesting picture, because for the Netherlands and Belgium, you saw very high growth in 2021, the expectations, due to the fact that companies not only expanded their e-commerce operations, but primarily also that companies were building up more safety stock. And then the Belgium and the Netherlands seem to be interesting countries to, as centrally located as they are, to build up that safety stock. But for this year, the expectation is lower. It has also to do with the fact that supply is limited. In the Netherlands and also increasingly in Belgium, we see that the availability of industrial land where new warehouses can be set up, that is difficult to find. And if there is demand but there is no supply, then the take up at the end of the day will be low. You see here also in Southern Europe, in the pictures of Italy and Spain, where Spain, particularly Barcelona, is still growing at a high level, because you can see the percentages are pretty high here with 15 and 30% last year and expectations for this year. And then we see in Central and Eastern Europe, high growth figures overall, certainly for last year, a little bit less than this year, so that impact of, hey, 2020 was a slow, then in 2021 was hot, and then this year we will come more at a more regularly expected pace. So that's the difference in Central and Eastern Europe. So you see that the figures change, but we also know that the figures vary per region. So take a country like Poland. If there is no way that you easily can compare or take these figures for Katowice and for Krakow and for Warsaw and for Gdansk. So logistics real estate markets are to a certain extent also regional markets. So here you see all in all the European expected 2021 take-up volume and the expected 2022 in one summary slide. And you see that 2022 is at a lower pace than 2021, as explained before. Let's now look to prime rents. And you see here in this slide and in the next slides, you see in blue the prime rent mid-2021. So we gave in the survey to all these people who participated, say, okay, well, these are in Q2, the summer of 2021, the current rents. What do you expect at the end of 2022? So blue is mid last year, green is at the end of this year. There is an overall growth of rents to be expected because demand is high. We see that land prices are going up. We also know that constructing warehouses is more expensive. There is also an element of increased inflation, which is involved here. So all over Europe, you can see that there is a difference in that all in all, you can see that all over Europe, there is a growth on average with 5%, and it varies a little bit per country. So you can see here also, for example, in Germany, you see the regional differences, right? You see Hamburg pretty fast growing, while Berlin is a little bit lower in terms of growth. So regional differences are important, and you can pick here the cities and the regions where you have a high interest in, but that rents are up, that's all over Europe the case. You see that also here in the Netherlands and Belgium. Belgium, both fast increase of rent levels. Belgium, which is so centrally located, had till a couple of years ago not that European distribution image as the Netherlands has, but that's picking up again. In the Netherlands, we see, for example, also that the Rotterdam area is doing very well. You would say that's logical because it's the largest seaport in Europe. But over time, we saw in many studies and surveys that Rotterdam was not one of the top logistics regions in the Netherlands. And according to our surveys last year and this year, we see really that Rotterdam is an important player in the Benelux logistics market. Okay, that's on, and on the bottom you see Italy and Spain, where particularly Barcelona is being seen as a more hot logistics region than the Madrid environment. The prime rents in Central and Eastern Europe are not increasing that fast. You see them overall at a lower level. Partly is that also because the last couple of years already the rents were going up in Poland, Romania, Czech Republic, and Hungary. So that's one of the explanations why the increases are now relatively limited. While the regions, we saw that previously, in the take-up is still doing very good. So here you see the differences for all the cities where we asked the respondents to give their expectation, and then we took the average of those. So that gives the input for this slide and the previous slide on what the growth rates will be in the various countries. And it's something, again, from an expectation point of view, but it can help you hopefully also in your day-to-day business to analyze and to get a feel for how our market's developing. Now, after rents, we go to the yields. And what you can see, and we saw that already last year, because this is the second survey we do. Last year, we started with that, so we are up to a tradition. We see that yield compression is all over the place with 40 basis points on average. Again, here it depends for various countries. Central and Eastern Europe has still an attractive yield, and here again, blue are the prime yields, prime net yields in mid-2021, and in green the expectations for later. And you will all, in nearly all slides, you will see that green is lower than blue. So yields are going down, meaning also, and it's a sign of the competition also in the market, because we know that there is an awful lot of money available from investors to invest in logistics real estate. We saw during the pandemic also that companies who invested heavily in offices or in retail or in hotels put money from those funds into the logistics real estate. And that's also what you see happening here. So that yield compression, that decrease of net prime yields is something we see all over Europe. And it's important to notice. So take here, for example, the Netherlands and Belgium. You know, it's not that long ago, I would say 4 or 5 years ago, that you had net yields of 6%. So the fact that they are so have come down shows is a signal of how the market is hot for logistics real estate investments, as you can see them here. And I mentioned just before Rotterdam, and that you see as a hotspot which is being recognized, let's say in the last 4 years more, and you see also that the yield compression there is substantial. Now in Central and Eastern Europe, here we see also yields going down, but you see here that the starting point is still above the 5% on average. So where we see in Western Europe already yields more in the area of 3.5%, 4.5%. Here you can see that in Central and Eastern Europe, yields are still higher than what we see in other parts of Europe. But that decrease of expectation of this year compared with last year, you can see that here in the the basis points which will decrease. So, and that is a substantial one. So that logistics real estate is the preferred, one of the very few preferred asset classes of real estate investors in Europe. That's a clear signal here. Now, that is also why the vast majority of the people we interviewed, more than 80%, said logistics real estate will be the next 36 months a strong asset with a favorable risk profile. So that hot appetite in logistics real estate will be there. And that appetite is not only from Europe-based investors, but also from non-European investors. Look at the question we posed to the interviewees was, how do you look at the appetite of non-European investors? And you will see here immediately that they are expected to be at a high level as well. Now, there is a lot of discussion about reshoring. Do you see that really happening? Reshoring means decentralization of production, so that companies say, wow, we saw during the pandemic how our supply chains were vulnerable, that if a plant closed down in China, we could not finish our product in Europe. Interestingly enough, we see that reshoring is still, according to the real estate developers and investors who talk with tenants every day, is at a not high level. And the reason for that is the following. If you want to de-risk your supply chain, you can, the fast way is just to raise inventory, right? We know companies who were proud that they had only for 15 days inventory, yeah, but if then something happens, whether it's a pandemic or whether it's a ship in the Suez Canal or whatever, you are in jeopardy. So building more inventory is relatively easy, though it's cost money, obviously, but it's a relatively easy to implement de-risking strategy. And that's far more, that's far easier than really shifting your manufacturing footprint. So yes, we see decentralization of production and distribution, but preferably with companies building up higher inventory levels in Europe to be more flexible if whatever happens, or whatever occurs, that they are flexible to respond, less on the reshoring of production side yet. We will see that our expectation in the future, but then on critical parts or smaller volumes, that's where probably that reshoring, that really decentralization of production will take an important role. We also asked the availability of warehouse workers will become the most important location factor. You see here a little bit diverse answers coming from all the respondents. That has also to do with the fact that we said the most important location factor. And I think that everybody would agree finding the right location is also very important. But that element of availability of workforce is an important element. That was even what people wrote in their comments to this question. Hey, it's a very important factor, but it goes a little bit too far to call it as of now the most important location factor. Now, we also in our survey looked a little bit deeper into two different types of distribution centers. You have the mega distribution centers and the urban distribution centers. And also in the public debate in the Czech Republic, in Germany, in France, in the Netherlands. So there's a lot of discussion about, hey, these super-sized warehouses, do we really want them? You know, often you hear in the media, these ugly, large buildings, is that really what we want? But from an efficiency and effectiveness point of view, we see still a lot of companies, brand owners, manufacturers, logistics service providers, finding mega distribution centers an interesting solution to the question they have, the efficiency of logistics operation, e-commerce, which is growing fast, but there is still a steep curve ahead. That stock from stores shifts towards DCs, and you need also space to handle the returns. And also strategic considerations of companies who say, well, we set up now a new distribution center or a new location. Let's take a larger plot so that we can also expand in the future. Now, the expectations for 2021 of these mega distribution centers are positive. You can see that here, dark green is where people said in comparison with 2020, we expect a strong growth, between 10 and 25% was expected by 31 of the attendees. But you see also near half say, well, more or less stable. So nobody says we expect a decline, but it's also like, it looks like that the curve of fast growing, the fast growth of mega distribution center is flattening a little bit. That's on the mega distribution center side. And we asked, what do you see as best countries to set up a new mega distribution center or develop a plot for mega distribution center XXL warehouses? In our definition, more than 40,000 square meters, so say 400,000 square foot. That those countries are particularly Germany, Poland, due to their size, also Netherlands probably also due to their good logistics position. And we asked the real estate people, the developers, the investors, the experts, hey, there is a lot of authorities in Europe who blame the logistics industry for these distribution centers, and 50% can, well, I understand why the public authorities have a negative sentiment towards these, the establishment of these large distribution centers. 50% disagrees. But it shows also that everybody, and we on a day-to-day basis, if we work for logistics service providers or for companies wanted to set up, or on the other side for logistics real estate developers and investors, this discussion on size, on where you put them, on the way how they are being landscaped, those plots, that's an important element here. Is there enough voice against those public authorities? Because sometimes you have also the impression that what happens in warehouses and the way how they are being automated and the added value being delivered there is not fully understood by everybody. You see here that 33% said, well, we agree that a European platform logistics real estate investors and developers would play a role, and also 50 said, well, let's think about that because that would be interesting. So it's also something we are going to do, to take an initiative to set up such a European platform to see whether what the arguments are of the logistics real estate industry for asking governments and pertinent authorities to give room to the logistics buildings is an important element to be there. And that can be in conjunction with sustainability or with labor market elements as well. The other side of this of the scale is city distribution. So here, in a combination of city hubs, last mile hubs, you know, there are the last touch points, there are various definitions on that. And here you see the picture is even more positive than on the XXL warehouses. Nobody expects a decrease. 58% expects a growth of 58% and a strong growth of 33%. So new distribution, city distribution centers are on the rise. It's definitely something we will expect what will happen in the next couple of years. And everybody sees that the number of new city distribution center hubs, not always, by the way, easy to find the right brownfield or greenfield location for them, but that is something what we will see here as well. In particular, when you ask what are the best cities, what are the hot markets for that, and although they have already quite a substantial number of city distribution centers that you see here, London, Paris, and Berlin, exactly the same, by the way, as last year, popping up again. Now, with that, I give the floor to Johan Beukema, partner for more than 20 years within our company, because we see in the questionnaire also concerns about the labor market. And the question is, what is the way how we can deal with that? Johan, the floor is yours.
Yes, and just to set the scene here, here's a recent article based on FedEx, the big global logistics giant, stating how important and what kind of impact labor shortages have on their business and their the way they run their business, because they stated that labor shortages cost FedEx $470 million. And that was really significant because it drove the fact that although their revenues were up nearly 3 billion due to growth of e-commerce, etc., their adjusted income stayed more or less stable because they had to make a lot of extra cost because of The most significant impact for that was caused by the labor shortages. And that was because of more wages, higher wages that FedEx across the line needed to pay. It was also due to inefficiencies, you know, extra partners they needed to hire, extra capacity they needed to hire from external in order to still get the volume handled as needed and requested by the market. So this is just as a clear example of how impactful labor shortages can be in the logistics industry. Now let's look a bit deeper at the labor market on the logistics industry side in Europe. So here's an overview of job vacancy rates in 2021 compared to 2019, so pre-COVID. In the middle, you see the average of the Euro area. And then a couple of observations when looking at this slide. What's clear is that there's a number of countries among others, Belgium, the Netherlands, Germany, Austria, that are significantly higher than the average across Europe. There's also a significant number of countries on the right-hand side that are below the average, but everywhere, you know, the pressure is building in terms of vacancies that are open, that are unfulfilled, that cannot be facilitated by the available labor pool. And another observation is that if you compare 2019 versus the current situation, or the most recent data from 2021, you can also see that some countries in 2021 are already higher in terms of having more vacancies unfulfilled than pre-COVID. And in other countries, it's the other way around, but really coming close to each other. So also showing that the pressure is building further, also when we are recovering from COVID. Now go a bit deeper in terms of the increasing demand for labor in the European market. Here's a survey by Manpower of last year comparing hiring intentions of big corporate companies in the EMEA region. And they compared the hiring intentions of Q4 2021, so the last full quarter that we had, with 1 year earlier, so Q4 2020. And the percentages on the chart here are showing the increase of hiring intentions in that 12 months period. And it's quite striking, right? So you can see that the Netherlands, for example, in the last quarter had 41% higher hiring intentions scored than a year before. And even the country on the chart here with the lowest percentage, Ireland, it's still 34% higher intentions of managers to recruit people. And if we compare that with North America at the bottom of the slide, you can see that the percentages are, especially for the United States, even higher. So also here, demand for labor is increasing, making having as an effect that the pressure is building. Here's another way of looking at that. So here we, based on our own databases, we made a comparison of job vacancies versus the number of employed. And looking at the map, you can see a similar picture. There are countries already colored red, meaning there's really a high pressure, there's really a high number of vacancies that cannot be fulfilled by the number of unemployed that theoretically are available to fill those jobs. There's a lot of countries colored orange, meaning also already a high pressure. And there is no country at all anymore for which we have data that's still coloring green, where availability is still well available. Just to be complete, the countries with no coloring here on the map are the countries where we had no comparable data available of this very recent period. So again, another sign that the pressure is there already and the pressure is increasing further. And the last few slides, they were showing kind of the situation of today. So they were showing the picture of what the labor market looks today. But also when we start looking at the future, it doesn't become much better. Also from demographic developments that are continuing in the next years, we can also conclude that this will add to the pressure in the labor market. And one of the driving forces there is the aging of the European population. As you can see on the chart here, the older age groups are, the number of people in those age groups are increasing, and the younger age groups are decreasing, meaning basically in absolute sense, a dropout of significant numbers of people from the available labor pools across the different countries in Europe. There are, of course, regional differences, and that accounts within Europe, as was shown also on previous slides. It's also when you compare Europe with the United States. But in Europe, it's clear, as certain studies are showing, that by 2030, so in about 8 years from now, 40% of Europeans may be living in regions with shrinking labor markets. 40% of Europeans living in regions with shrinking labor markets due to, amongst others, the aging effect that I was showing on the previous slide. Compared to the US, that's also a striking number, because in the US, that's only 11% according to similar studies. Now, so the pressure is building, and we also see that in our practice. So a lot of companies, be it on the logistics developer side, be it on the logistics service provider side, or on the end user side, are looking more and more carefully at their labor markets and what's happening in those labor markets, both in looking at existing locations and how the existing location can still further facilitate growth, and also in the choice of new locations, having an ever more detailed look at the labor market potential. And what we did is we developed a new method, which we call IDEAL. IDEAL stands for in-depth assessment of labor markets. And this slide shows the different elements of that IDEAL method, where if I take you through quickly, you see the basis is by analyzing supply and demand in the labor market. On both sides, it means, of course, looking at basic statistics that are available, making the picture of the current situation, as I was showing on previous slides as well, but also looking at forecasting based on statistics available, but also enriching that with qualitative inputs from experts in the different labor markets in scope. So talking to recruiters, talking to development agencies, talking to companies actually located in those labor markets, and building their experiences and expectations in, and looking at all kinds of other elements on the supply and demand side, but also looking at what can you as an employer do. So looking at the employer's offering from a basic earnings, wages perspective, looking at secondary benefits, fringes, training and reskilling propositions to labor force, etc. And by combining those elements into different packages, like, hey, what is our competitive position? What is our feasibility to recruit the right number and the right type of people? If we just offer a basic offering to the labor market, basic wage, basic secondary packages, versus what if we offer a more competitive or even a real front-running package to the labor market. Now, also looking at labor regulations and conditions and their impact, and last but not least, also looking at how can the region itself, how can economic development agencies, authorities support you as a company to recruit the right people and to retain the right people and to train the people in the way they need to be trained to be able to do the job. So a complete assessment in detail of labor markets, quantitatively, but also qualitatively, not only looking at today, but also carefully projecting the situation towards the future. That's what this IDEAL method is about. If you look at top incentives that employers are offering to attract and retain in-demand talent, looking at this survey, and what strikes here is that increasing wages is not on top here. So there's more than just increasing the wages. Of course, that's with the 31%. It's an important incentive that employers are offering, but they also experience that just increasing wage is not helping them fully. So also training, skills development, mentoring. So offering that to employees and potential employees is important. Being more flexible, addressing more work-life balance, etc., is also regarded as important by employees and potential employees out there in the labor market. So there's a whole mix of different measures that companies are taking and should be taking to be able to attract and retain their talent. Now, to close off, quickly a case of, in this case, a global logistics company active in e-commerce, a lot of locations across Europe and further aggressive expansion plans. And the key question they asked us is, hey, what is the expected feasibility of recruiting really significant amounts of warehouse workers in the 20 main logistics regions in the EU, of which most of those locations this company already had sites, and others they were planning to set up sites. And what we did there is exactly applying that ideal method. So we looked at statistics, we projected data towards the future. We did field work, talking to recruiters, talking to peer companies, etc., to come to a good projection of the feasibility of hiring different amounts of workers in those regions. There were a lot of local specifics taken into account. I'm mentioning one. So we specifically looked at what is the potential in hidden or untapped labor pools where the company never looked at before, like people coming out of the hospitality sector, people looking at looking at female workers aged 30 to 40. Is there a specific opportunity or not? So detailed deep dives on that. And as a conclusion of that study, it was clear that labor market pressure was there already in all these top 20 regions, and also expected to increase significantly in the years to come. And that meant that this company needed to develop a very focused employer branding strategy, and also to develop and deploy targeted strategies to get access to those untapped labor pools that I was just talking about. So this just as a practical example of how we have applied this ideal methodology in the case of a specific e-commerce company in Europe. Now, with that, I'm handing over to Tom to talk about the changing business case of automation and robotization in warehouses.
Okay, hello. Thank you, Johan. So my name is Tom Bonkenberg. Thank you very much, Renee and Johan, for inviting me to join you at the seminar today. I work for a company called St. Ange Company, and just a brief description so you know where my background is. We're an engineering consulting company that helps people design their supply chains, internal logistics inside the building and external, whether it's a supply chain network. We also work around the world, and we've been a long-standing partner with Buck Consultants. In fact, my team is in the same office building as they are. And we have headquarters in the United States, but we have offices around the world. What I'd like to talk about today is this labor challenge. Most people think that people are automating these warehouses to take care of this challenge. But the reality is most warehouses are manual. So we do surveys of our own clients, and we maybe 5 to 10% are really automated, like you see in the magazines. Maybe 15% are mechanized, where they have some conveyors and sorters, and still about 80% of warehouses are manual. Backing this up, some recent surveys that show AGVs, which are a type of robot forklift, still are only in less than 10% of warehouses. More automation, people are thinking about it in 10, 15%, but still 80% people aren't looking at them, and the same with robotics. So with all the labor pressures that Johan just described, why is this? Well, one of the reasons is the way companies look at payback. So simple payback, usually you'll have a project cost, an investment in some kind of automation, and then you want to have a payback period. So if you take your project cost, divide by how much you save, you want to have a payback in a certain number of years. And we see in surveys, and we see this just in our real life projects, that 16% of companies want less than a 12-month payback. If you're on the stock exchange and you're publicly traded, you want a fast ROI. Only 4% of companies would accept more than 3 years. So this magic number of 3 years or less has been driving the industry when they decide about automating their warehouses and distribution operations. And we see it's very difficult to automate when you have a 3-year payback or less. As an example, okay, this is an example client of ours. It's a home improvement retailer in Europe, about 150 stores, about 10,000 items that they sell. They're selling about 15,000 items per day e-commerce. And they wanted to design a new e-commerce distribution center. So our team of engineers helped them design and look at all the options on how to set up and design this distribution center. So the first thing we did is we did a design that was best in class manual operation, had good IT, but with cart picking, people picking the carts and pallets, a manual process, but a good, well-designed manual process. This would give them the lowest capital equipment option, but still would have the highest labor. And we saw in this case, it was about 90 people and about 4 million euros in equipment investment inside of their building. Then we did an option where we added mechanization, adding conveyors and sorters. What you would see that 15% of companies would add to their distribution center. So you're picking into totes onto conveyors, you're picking cases onto conveyors, you have automated transport and labeling of finished boxes, maybe a shipping sorter. And we see we brought the labor down 20 people. We went from 90 to 70 people, but the investment went up. Of course, you had another 2 million euros investment, and that gave a payback of around 2.5 years. And that's where a lot of companies would say yes. Not all, but a lot of companies say, well, less than a 3-year payback, we'll spend this extra capital to save these people. And we said, all right, what if we take what would be state of the art of accessible technology, not crazy, but things you could actually buy if you put the effort in. So some robotic case picking for a selected number of items, some shuttle systems, which brought the parts to the people, so they did a lot less walking, and some automated packing systems. And again, we could save another 35 people. So we went from 90 people down to 55, but the investment now went to 11 million euros of equipment. And this now hits a 5-year payback. That's above what most companies would accept as an acceptable ROI. But people are starting to think about this differently, because if you just can't find the people, what do? Most projects were a savings project. You know, can I save labor costs to justify this equipment? But what happens if the people don't show up? What happens if you need 90 people, but you can only find 70? Well, this will actually reduce the revenue of what you can do in your distribution center. So if you only have 70 people when you need 90, you might have 8 million euros in lost revenue of items you can't ship, which could be 2 million in gross profits. So the companies are now looking at what is the strategic cost of not shipping orders? What is the strategic cost of not being able to help our customers? What if we lose a customer and they don't come back? Now, most ROI calculations do not include this in their accounting, but companies at the higher level are trying to make a strategic discussion. Can we take the risk of not finding people? And suddenly it goes from a cost-saving exercise to a strategic exercise. And then magically the ROI that's acceptable, 3 years is not the threshold. It's more, we have to do this to continue our business and continue operation. And it goes into a strategic bucket. So some quick thoughts on automation. You know, typical drivers for ROI, it's the labor costs. When your labor and land costs are high, it's easier to justify the automation. When your quality requirements high, many people argue it's good for automation, but I'd argue a very well-designed manual system can still give you the same quality if you've done a good job with your processes. The more complex your order, it's more difficult to automate. The more risk of product changes. Automation is not very flexible, so that can be a difficult challenge. You end up putting more and more capital in, the more flexibility you need in your supply chain and your products. The more you have a high peak to average ratio, the more your peaks are compared to your average day, the more expensive automation is. It's like building the church for Easter Sunday. Easter Sunday, you need the full church. The rest of the year, maybe not so much. So this is why automation gets expensive as you see higher peaks like in e-commerce. All the things we have on this list affect ROI. So it's not just about direct labor savings, but it's about the products you have, the shipping profiles, the type of customers, and the flexibility you need in your supply chain. So a couple other things to think about if you're thinking about automating or you know someone who is. One is the maintenance cost extends ROI. So that nice payback I showed you that was 5 years actually is 7 years if you include all the proper maintenance costs. Preventative maintenance, spare parts, and things like that. And that's very often not included in the ROI calculation, but comes back to hurt people. The other challenge that can happen, especially in large capital investments, is there's always a future growth projection. And if you don't hit that growth, what happens is equipment has the same depreciation cost. And if you don't hit the volume growth you expected, your cost per unit will not gain the benefit of the automation. So you have to be very careful about projecting your future growth against automation. Automation can put a bit of handcuffs on you and reduce your flexibility. So it's something you need to understand in your business. Is this a business that's going to change? Or maybe we only automate the parts we know are stable and we're confident in. And automation often requires a more complicated team, a team with more experienced managers and supervisors, a new way of thinking. A very automated distribution center is more like a factory than it is a warehouse. So you have to think differently and maybe hire a different staff to run and operate it, including maintenance and IT. But on the good side, when you're making the ROI calculation, look for additional savings. You know, can you find some quality improvements the automation will bring? Can you lower your HR or recruitment and training costs? Can you take out ergonomic and lost time issues? What other things can you see? Speed to market. What else will the automation bring that is maybe not in the ROI calculation, but is interesting for the company as a whole? Companies are also now looking at alternative financing models. When we see mobile robotics, companies are looking at renting them instead of selling them. And this turns it from an CapEx discussion into an OpEx discussion. And very often a local site can make a decision to rent robots without having to have a capital committee or a big board level discussion. And that's changing the way people think about automation with a specific set of technology. Basically things that you can rent and return, then you can look at this as a service instead of just a capital investment. So in your company that you work with, can you change it from a tactical to a strategic discussion when you talk about automation? And then we see it unlocking for a lot of our clients. As we look at the complexity of your warehouse, it really depends on how big you are, how complex you are, what kind of automation you can do. Small operations with a few number of items with low volume per day, it's still very difficult to automate. It's really when you get to the medium and more complex operations that we see automation really kicking in even for these justifications. That's changing, but we still have to match the automation to the business. Finally, I'd like to close on, it's not only about labor. When clients come to us for help, usually they have a problem. It's either we have a problem, we don't have enough space, or we can't get enough throughput, we can't get enough orders out of the building, or our costs too high, our productivity is not good. And they often focus like a laser on their problem. But what happens is when you focus on one, you often hurt yourself in other areas. So we always say it's important to look at the whole picture. You need to look at your space utilization, your ability to get orders out the door, and your productivity, not just labor. And if you're focusing on labor, make sure whatever you design isn't hurting yourself in the other areas as well. And finally, there's innovations every day. This is a robot from Boston Dynamics. Boston Dynamics is a company in the US that makes the fancy robots you see on YouTube that do flips and jumps. Well, they also make a more boring robot. They launched it in March 2021. And just this week, DHL announced they're buying $15 million worth of these robots to put in their distribution centers. That was announced about 3 days ago. So every day I make a presentation, something new is happening in this area. So I'd like to now turn it over to Renee for the next part.
Thank you very much, Tom. And let's wrap up and also look on how you can get the presentation on in your email inbox. Now, overall, looking to the survey did among Europe's leading logistics real estate developers and investors, they expect a take up in 2021 of 10% growth compared with 2020, and this year at a lower pace. Main markets, Germany, France, and UK are still doing very well. The Benelux a little bit lower for this year after a very high growth in 2021. And Central and Eastern Europe still shows a strong growth in take up, also outside Poland, because Poland was already on that top list, on the top of the list for a couple of years. Net prime yields decreasing all over Europe, depends per city, as we have shown you before, but on average with 40 basis points. Rents are up, but here are also substantial regional differences. So be aware of what's happening on a regional level. The mega distribution centers expected strong growth, but perhaps a little bit less than 2 years ago, while city distribution centers are still very fast growing all over the place. Availability of labor is a key location factor. So that's an important element which Johan highlighted. And that well-thought automation and robotization helps to keep revenues and profits. And what we see, and Tom gave you an excellent example of that, it's not anymore a discussion, hey, I invest 2 million and then I don't need 5 people anymore, and you make a comparison of CAPEX, OPEX. If you don't find the people anymore, or you can automate and use the people you have in your warehouse for other tasks, then it's more a strategic decision how you automate and robotize. So that's an important element here as well. Perhaps a final slide is on how you get a download of the presentation. Now, if you go to our website, www.bciglobal.com, go to the English version, and then you see there an article which talks about logistics real estate markets break record. And click on that article and you get a download opportunity. So you can get the full presentation you saw in this hour for that. The If you want to see the webinar back, we will edit a little bit the presentation this morning. So as of Monday afternoon, you can find that on the same website. Just for you also, as you are interested in these kind of topics, there are 2 free of charge upcoming events which might be of interest to you. Next Tuesday, there is broadcasters from the UK, Supply Chain Talks of Business Reporter. That's about decentralization of distribution and manufacturing. With a great panel from Avon and with Penn State University, aside to Patrick Haaks, who are our managing partner within BCI on supply chain solutions. And they will talk on what are the hurdles for companies to reorganize their supply chains and what are the main directions we see today. 2 weeks later, we have a webinar which we run together with Supply Chain Media on global reshoring and footprint strategy. So that might also be interesting for you to take a closer look at. And we have there also a brand new survey, one of the largest surveys done among manufacturers in the US and Europe, to talk about that decentralization trend. Is that reshoring really happening or not? A framework for footprint strategy. And we have a great panel there with Steve and Edgerman from Newell Brands and from Quick. So also, if you will find more information about those upcoming webinars on our website. That's also where you can register, as mentioned before, free of charge. So for now, looking also at the clock, we are good in time. So first of all, thank you very much, all 300 of you, for participating this morning in the webinar. Go to our website if you want to download the presentation or come back to us with remarks, comments, whatever. Look at upcoming events, which are mentioned on that website again and on our LinkedIn, and see whether that's of interest for you for the future. So for now, thank you very much for your time. Also, thank you to my co-presenters this morning, Johan and Tom, and looking forward to meeting you online and hopefully also in the future offline again. Thank you very much and have a great day. Bye-bye.